The silver alert. Why the overnight crash matters right now. What happens next? In the early hours of a seemingly ordinary trading session, silver didn't just fall, it collapsed. Not gradually, not predictably, but with a velocity that erased billions in market value before most traders even opened their eyes. The question isn't what happened. The question is what this reveals about the fragility beneath global markets right now. Because this wasn't random, this was structural. And if you think this is just about one metal on one night, you're missing the warning sign that could reshape your entire financial strategy in the months ahead. What comes next will determine who is prepared and who gets caught in the undertow. Welcome to John Analyst. Now, before we dive deep into what this crash truly means, let me ask you something. In the way I'd ask someone with years of experience under their belt. You've seen markets move before, haven't you? You've watched events unfold, made decisions, perhaps learned hard lessons along the way. So, do me a favor. If you value analysis that cuts through the noise and gives you the strategic clarity you actually need, hit that subscribe button. Not because I'm asking for a favor, but because in times like these, having access to disciplined third-person analytical perspectives could be the difference between reacting and responding. And while you're at it, drop a comment below and tell me, where in the world are you watching this from? Are you in North America, Europe, Asia, the Middle East? Because understanding where capital is watching from helps me understand where the questions are coming from. Now let's get into it. On the night of February 5th, 2026, while most of the Western Hemisphere slept, something broke in the silver market. Not metaphorically, structurally. At approximately 2:47 a.m. Eastern Standard Time, silver futures began a descent that would see the metal shed nearly 8% of its value in less than 4 hours. To those unfamiliar with precious metals, volatility, 8% might sound manageable. To those who understand the mechanics of leveraged commodity markets, this was a liquidation event. The price didn't drift lower on weak sentiment. It didn't gradually erode on profit-taking. It fell through support levels like a stone dropping through water, each breach triggering cascades of automated sell orders that accelerated the decline further. By the time London markets opened, silver had touched levels not seen in over 3 months. The 24-hour trading volume had already exceeded the previous week's total. Volatility indices, specific to precious metals, spiked to readings typically associated with crisis conditions. This was not normal price discovery. This was forced liquidation in thin market conditions, amplified by algorithmic trading systems designed to exit positions when technical thresholds are breached. But here's what makes this event significant beyond the immediate price action. The support level that broke wasn't arbitrary. It represented a trend line that had held for 17 consecutive weeks. It marked the lower boundary of an ascending channel that had characterized silver's behavior since late October 2025. And it's at precisely at a Fibonacci retracement level that technical traders worldwide had identified as critical support. When that level failed, it didn't just break, it shattered. The distinction matters. In normal volatility, price tests support, finds buyers, and stabilizes. In structural breaks, price slices through support zones, finds no meaningful buying interest, and continues falling until it reaches the next concentration of limit orders, which in this case sat nearly 6% lower. What the charts revealed was a market that had become dangerously one-sided. Commitment of traders data from the week prior showed speculative long positions at levels exceeding 90% of historical readings. In simpler terms, nearly everyone who wanted to own silver already owned it. The marginal buyer had disappeared. And in markets, when the marginal buyer disappears, price doesn't plateau. It searches for the level where new buyers emerge. That search is rarely gentle. Compounding the structural vulnerability was the timing. The crash occurred during Asian trading hours, when liquidity in silver futures is notably thinner than during New York or London sessions. Fewer market makers, wider bid-ask spreads, lower order book depth. In such conditions, a large sell order, whether from a leveraged fund reducing exposure, an algorithmic system executing a stop loss, or a participant forced to meet a margin call, can move price disproportionately. And once price begins moving against a crowded position, the mechanics become self-reinforcing. Falling prices trigger stop loss orders. Stop loss orders create selling pressure. Selling pressure drives prices lower. Lower prices trigger additional stops. The feedbacky. Loop accelerates until buyers finally step in at levels compelling enough to absorb the wave of forced selling. By 7 a.m. Eastern, as European traders fully engaged, silver had stabilized, but 23% below its intraday high from just 60 hours earlier. The bounce from the lows was sharp, aggressive even, suggesting that real demand had emerged at deeply oversold levels. But the bounce itself raises questions as important as the crash, because in markets, the first bounce after a structural break is rarely the final low. More often, it represents short-covering, algorithmic mean reversion strategies and opportunistic traders betting on snapback rallies. The true test comes in the hours and days that follow, when the market must prove whether genuine accumulation is occurring or whether the bounce is merely a pause before further decline. What makes this overnight crash strategically significant is not the magnitude alone. 8% moves, while violent, occur periodically in commodity markets. What matters is the context. Silver had been trading in a manner consistent with strong underlying demand. Industrial consumption data remained robust. Physical premiums in certain markets had been elevated. And yet, the paper market collapsed with a speed that suggested either massive position unwinding or a fundamental reassessment of near-term risk. The divergence between physical market indicators and paper market behavior is where the real analysis must begin. Because if this crash represents nothing more than over-leveraged speculation getting flushed, the implications are tactical. Traders adjust, markets reset, life continues. But if this crash represents something deeper, a signal that the forces which drove silver higher are reversing, or that liquidity conditions in broader markets are deteriorating, then the implications extend far beyond one metal on one night. The question that now faces every participant, from industrial consumers to portfolio managers to individual investors, is simple but critical. Was this a flush or a fracture? The answer will determine what happens next. Understanding why silver collapsed requires abandoning the search for a single headline. Markets do not move on singular causes when positioned at extremes. They move on the convergence of multiple pressures, each independently manageable, but collectively overwhelming. The overnight crash was not the result of one trade, one news event, or one policy shift. It was the result of architectural fragility meeting a catalyst in an environment stripped of liquidity. Start with what most market participants missed in the weeks preceding the event. The Federal Reserve had not changed interest rates. No emergency meeting had been called. No dramatic policy pivot had been announced. And yet, the language embedded in recent Federal Open Market Committee communications had shifted in subtle but meaningful ways. References to monitoring inflation dynamics closely had replaced earlier assertions of inflation moving sustainably toward target. The difference appears semantic to those fluent in central bank communication. It signals hesitation. And hesitation, when decoded by algorithmic trading systems and institutional risk models, translates into probability adjustments for future rate paths. Those probability adjustments matter because silver, unlike gold, carries no yield. Its value proposition depends entirely on either industrial demand growth or the expectation that holding cash equivalents will lose purchasing power faster than holding tangible assets. When real interest rates begin rising, even marginally, the opportunity cost of holding non-yielding assets increases. In the 48 hours before the crash, the 10-year Treasury yield had climbed 17 basis points, modest in isolation. But when overlaid against positioning data showing extreme speculative length in silver, 17 basis points becomes material. Then there's the dollar. The US dollar index had appreciated nearly 2% over the preceding 10 days. For commodities priced in dollars, currency strength acts as a headwind. A stronger dollar makes silver more expensive for foreign buyers, potentially dampening physical demand, while simultaneously making dollar-denominated alternatives more attractive for capital-seeking safe haven characteristics. But monetary policy and currency dynamics alone do not explain the speed of the collapse. For that, one must examine the structural positioning that had accumulated beneath the surface. Commodity Futures Trading Commission. Data released the Friday before the crash revealed speculative net long positions in silver futures at levels exceeded only twice in the prior decade. Both prior instances had preceded corrections exceeding 12% within 30 days. This concentration of one-sided positioning creates mechanical vulnerability. When the majority of market participants hold the same directional bias, the exit becomes crowded. And crowded exits in leveraged markets do not proceed in orderly fashion. Margin requirements amplify the effect. Silver futures are traded with leverage ratios that can exceed 15 to 1. A 5% adverse move against a leveraged position does not result in a 5% loss. It results in a 75% loss of the initial margin posted. At certain thresholds, brokers issue margin calls. Participants must either deposit additional capital or liquidate positions. In the hours when silver was collapsing, margin calls were being issued across multiple time zones. And many of those calls were being met not with fresh capital, but with forced selling. The liquidation was further accelerated by systematic trading strategies that dominate modern commodity markets. Trend-following algorithms, which had been programmed to buy on upside momentum, reversed their positioning when key moving averages were breached. Volatility targeting funds, designed to reduce exposure when price swings exceed predefined parameters, automatically sold into the decline. These are not discretionary decisions made by human traders assessing fundamentals. These are mechanical responses executed in microseconds based on price action alone. The result is a feedback loop where selling begets selling, where technical breakdowns trigger systematic liquidation, and where the absence of natural buyers during low liquidity hours allows price to fall further than fundamental value might justify. Yet beneath the technical and structural explanations lies a question that cannot be ignored. Had industrial demand signals begun to weaken? Recent Purchasing Manager indices from China, the world's largest silver consumer, had shown marginal deceleration. Not collapse, not crisis, but deceleration. Manufacturing. Activity in the electronics sector, a significant source of silver consumption, had ticked lower for 3 consecutive months. Solar panel production forecasts, which had been revised upward throughout 2025, were now being adjusted downward by several European analysis firms. The revisions were minor, 2 to 3% reductions in growth expectations, but in markets priced for perfection, minor disappointments can trigger disproportionate reactions. Automotive sector demand, particularly from electric vehicle production, which utilizes silver in battery management systems and charging infrastructure, had plateaued. Not declined, plateaued. But plateau, when priced into a market expecting acceleration, becomes a negative catalyst. The convergence is what mattered. Monetary policy uncertainty, dollar strength, extreme speculative positioning, mechanical selling from algorithmic systems, marginal softness in industrial demand indicators. Individually, each factor is manageable. Collectively, in a market trading during its lowest liquidity window, they became an avalanche. And avalanches do not stop at convenient levels. They stop when the energy is exhausted. The question now is whether the energy has been exhausted, or whether this was merely the first slide in a longer destabilization. Silver has collapsed before, and those who ignore its history are condemned to misinterpret its present. The metal's behavior follows patterns that repeat, not because markets are predetermined, but because human psychology, leverage mechanics, and monetary conditions cycle through recognizable phases. Understanding where the current event fits within those cycles is not academic. It is strategic. Begin with 1980. The Hunt brothers' attempt to corner the silver market drove prices from $11 per ounce to over $50 in a matter of months. The parabolic ascent looked unstoppable until it wasn't. When margin requirements were raised and credit tightened, the structure collapsed. Silver fell 70% in 8 weeks. The lesson was not that silver was worthless. The lesson was that exponential price rises built on leverage and speculation cannot sustain themselves when liquidity contracts. The parallels to the current environment are not precise, but they rhyme. Speculative positioning at extremes, leverage embedded throughout the participant base, a price structure that had become detached from gradual fundamental improvement, and then a catalyst that exposed the fragility. Move forward to 2011. In the aftermath of the Federal Reserve's second quantitative easing program, silver surged from $17 to $49 in less than 6 months. The narrative was compelling. Central banks were debasing currency. Inflation was inevitable. Hard assets were the only rational hedge. The narrative was correct in direction, but wrong in timing. Silver peaked in April 2011 and entered a correction that ultimately saw the metal fall to $13 by late 2015, a 73% decline from peak to trough. Not because the monetary thesis was false, but because the market had priced in a decade of inflation in 6 months of speculation. The correction was brutal, but those who understood the difference between a cycle correction and a structural breakdown recognized that the fundamental drivers had not reversed. Governments were still running deficits. Central banks were still expanding balance sheets. Industrial demand was still growing. What had reversed was sentiment and positioning. The market needed time to reset, to clear excess speculation, to rebuild a foundation from which the next advance could be sustained. And reset it did. By 2020, silver had returned to the high teens. Then came the pandemic. March 2020 brought liquidity crisis conditions across all asset classes. Silver, despite its safe haven reputation, was not immune. In a matter of days, the metal fell from $18 to $12, a 33% collapse driven not by silver-specific fundamentals, but by systemic deleveraging. But within months, as central banks unleashed unprecedented monetary expansion, silver reversed violently. By August 2020, it had reclaimed $30. The round trip from panic low to recovery high took less than 5 months. The pattern across these episodes reveals a consistent truth. Silver's crashes are severe. Its recoveries are explosive. And the determining factor is whether the underlying monetary and industrial conditions that support the asset remain intact or have fundamentally deteriorated. In 1980, monetary policy tightened aggressively under Paul Volcker. Real interest rates went deeply positive. That was a regime change. The correction was not temporary. In 2011, monetary policy remained accommodative, but markets had front-run the inflation trade by years. The correction was a repositioning, painful but not terminal. In 2020, the crash was liquidity-driven, not fundamental. Once liquidity returned, so did price. The current crash must be assessed through this lens. Has monetary policy entered a tightening regime that will persist for years? Or is this a temporary recalibration within an ongoing cycle of currency expansion? Has industrial demand structurally collapsed? Or has it merely decelerated from unsustainable growth rates? Has speculative positioning been fully cleared? Or does further liquidation remain embedded in the system? The gold-silver ratio provides additional context. Historically, this ratio oscillates between extremes. When silver outperforms, the ratio contracts toward 40 or 50. When gold outperforms, the ratio expands toward 80 or 90. Prior to the crash, the ratio had compressed to 62, not an extreme by historical standards, but indicative of relative strength in silver. The overnight collapse pushed the ratio back toward 71. A sharp move, but still within the range of normal cyclical fluctuation. Compare this to 2020, when the ratio spiked to 123 during peak panic, or to 2011, when it contracted to 31 during peak speculation. The current reading suggests dislocation, but not crisis. Intermarket behavior offers further clues. During genuine systemic stress, correlations across asset classes converge. Everything sells off together as liquidity is prioritized over valuation. During isolated corrections, correlations diverge. In the hours surrounding the silver crash, gold declined modestly, less than 2%. Copper remained stable. Equity markets showed no distress. Treasury markets functioned normally. This was not a systemic event. This was a silver-specific liquidation, which brings the analysis to cycle theory. Commodity supercycles typically span 15 to 20 years from trough to trough. The previous trough in precious metals occurred in late 2015 and early 2016. If the current cycle follows historical duration patterns, the structure should remain intact until the late 2020s or early 2030s. Within supercycles, individual metals experience multiple intermediate corrections. These corrections typically retrace between 38 and 62% of the preceding advance. They serve to clear excess speculation, reset sentiment, and establish new bases for continuation. The current decline, measured from the recent peak, has retraced approximately 41% of the rally that began in October 2025. Textbook intermediate correction territory, not terminal, not structural breakdown, but requiring time and base building before the next advance can commence. History does not repeat, but it provides probabilities, and probability favors reset over collapse. What matters now is not what happened. What matters is what comes next, and how decision makers position themselves for multiple potential outcomes. Markets do not provide certainty, they provide probabilities, and strategic participants do not bet on single outcomes. They construct frameworks that allow them to respond effectively, regardless of which scenario unfolds. The immediate technical landscape reveals 3 critical levels that will determine silver's trajectory in the weeks ahead. First, the breakdown point itself. The trend line that failed sits at approximately $28.50 per ounce. This level has now flipped from support to resistance. Any rally attempt that approaches this zone will face selling pressure from participants who bought at higher levels and are seeking to exit positions at reduced losses. If silver can reclaim this level and close decisively above it on sustained volume, the correction likely ends. The failed breakdown becomes a bear trap. Shorts cover, momentum algorithms reverse, and the market reprices higher. But if silver approaches this level and is rejected, if buyers cannot recapture the broken structure, then the message is clear. The market is not ready to resume the prior trend. Further consolidation or decline becomes probable. Second, the demand zone that emerged during the crash. Silver found aggressive buying support near $26. This level aligns with the 61.8% Fibonacci retracement of the October to January rally. It also coincides with a volume profile node showing historical accumulation. If price returns to this level and holds, if buyers defend it on a retest, the low is likely confirmed. Participants can begin constructing positions with defined risk parameters. If price returns to this level and breaks below, the next support zone does not appear until $23.70. A breakdown to that level would represent a deeper correction, one that would test the conviction of longer-term holders and potentially trigger a new wave of capitulation. Third, the 200-day moving average. This longer-term trend indicator currently resides near $27.40. It represents the average cost basis of all participants over the past 10 months. When price trades above a rising 200-day moving average, the trend is classified as intact. When price falls below and the average begins to flatten or decline, trend deterioration is occurring. Silver currently trades just above this average. The proximity matters. A decisive break below would shift the technical classification from correction within an uptrend to potential trend reversal. These 3 levels, resistance at 28.50, support at 26, and the moving average at 27.40, define the battleground. From these technical parameters, 3 distinct scenarios emerge. Scenario A, rapid recovery and resumption. Probability 30%. In this outcome, silver reclaims the broken trend line within 10 trading days. Industrial demand data from China and the electronics sectors surprises to the upside. Dollar strength reverses as Federal Reserve communication shifts back toward accommodative language. Short covering and momentum buying drive price back toward previous highs. Catalyst requirements, positive purchasing manager indices, central bank policy pivot signals, or geopolitical developments that increase safe haven demand. Time frame, 2 to 4 weeks. Scenario B, extended consolidation and base building. Probability, 55%. In this outcome, silver trades in a range between $26 and $29 for an extended period. Neither bulls nor bears achieve decisive control. Speculative positioning normalizes, volatility contracts. The market digests the recent move and rebuilds participation on both sides. This is the highest probability scenario because it allows time for the structural imbalances that cause the crash to fully clear. Overleveraged positions exit. Sentiment resets from euphoric to neutral. A new base forms from which sustainable advance can eventually resume. Catalyst requirements, absence of major new fundamental developments, stable monetary policy, gradual improvement in industrial demand indicators, time frame 2 to 4 months. Scenario C, deeper correction towards structural support. Probability 15%. In this outcome, silver breaks below $26 and tests the $23 to $24 zone. Additional forced liquidation occurs. Sentiment turns deeply negative. Physical premiums compress as holders liquidate inventory. Mining equities suffer disproportionate declines. This scenario becomes probable only if industrial demand deteriorates meaningfully or if broader financial market stress emerges that forces commodity liquidation for liquidity purposes. Catalyst requirements, significant economic slowdown in China, aggressive Federal Reserve tightening or systemic credit event. Time frame, 1 to 3 months, followed by extended recovery period. Each scenario requires a different response framework. For industrial consumers who use silver in manufacturing, Scenario A requires securing supply before price rises. Scenario B offers time to negotiate favorable contracts during range-bound conditions. Scenario C presents opportunity to lock in multi-year supply agreements at depressed prices. For investors and portfolio managers, Scenario A rewards those who accumulated during the crash. Scenario B favors patience and disciplined entry at range lows. Scenario C demands capital preservation and willingness to wait for capitulation signals before deploying significant capital. For risk managers and hedgers, all 3 scenarios require monitoring implied volatility levels, which have expanded significantly. Elevated volatility increases option premiums, making hedging more expensive, but also more necessary. The framework is not prediction. The framework is preparation, because markets reward those who can respond to what is happening, not those who bet everything on what they believe will happen. The data will reveal which path is unfolding. The disciplined will be positioned to act when it does.